Hey everyone, and welcome to Talk ETFs, ETF.com's weekly video series. My name is Sumit Roy, and I'm senior analyst here at ETF.com. This week, I'm speaking with Sean O'Hara, who's president at Pacer ETFs. Sean, thanks so much for being on the show.
Thanks for having me. It's always good to be with you.
Absolutely. So, Sean, you just launched a new ETF, a very interesting ETF that targets the Nasdaq, but in an interesting way. Apparently, this ETF aims to provide 6 times the dividend yield of the Nasdaq. How does that work?
Well, I'll do a little history, if you will. We have a different version of it on the S&P 500. That ticker is QDPL. It's been out for 3 years now. This is a sister product, if you will, to that. You know, we like to build products in silos, if you will. So essentially what we're doing, if you think about the NASDAQ 100, you can think of it as 2 component parts for total return. The price return, how much the stocks go up and down, and then what the dividend yield is, and the component to that. And what we're doing with QSIX is we're pulling apart the NASDAQ and then putting it back together the way we want so that we can achieve that 6 times the yield number. And essentially the way it works is about 85% of the money is going to be invested directly in the NASDAQ 100 stocks. So think about like if you bought QQQ, for example, you'd own all the individual stocks in that ETF. For this ETF, we own all the individual names, so 100 names weighted exactly like NASDAQ. The remainder of that portfolio balance, at 15% or so, is used as collateral. And with that collateral, we go into the dividend futures market, and we simply do math. And so if I have 85% of my money in the NASDAQ and I'm targeting 6x, that means I already have 0.85, right? So I need 5.15 times more income. And so we can go into the dividend futures market. We buy this year's dividend strip, next year's dividend strip, and then the third year's dividend strip. And those dividend strips sort of accumulate and pay out over time. And so the objective here is to get the majority of the return of the NASDAQ, but in a format where you're getting a much higher distribution in terms of yield. We know this strategy works because we've been doing it for QDPL and the S&P 500. We target 4 times there. That's why that ticker's QDPL, quadruple, if you will. This is QSIX, which is the 6. And the whole idea behind it really is simple, is that there are investors who invest in equities that they try to target income. You know, some of the more popular ways that people do that would be for covered call strategies, let's say, or dividend-focused investing. The downside, if you had one for covered call strategies, is that you're selling away your upside. So you're getting a very attractive yield. That's the premium you get for writing those calls, but you're essentially tapping out your upside. With QSIX, we don't do that. What we do is we say we're going to get 85% of the equity return, so we're not uncapped on that part of the portfolio, but we're going to deliver that 6 times income, which right now would be about just a little under 5%. And so for investors looking for income, they're not only looking for income today, but they want income in the future. And so we're going to target a high distribution yield here, 6 times the dividend yield of the NASDAQ 100. But over time, we think that the money will grow faster because it's not constrained by using a covered call type strategy.
So, Sean, this certainly sounds like a very compelling strategy. You mentioned the covered call ETFs, how they give up upside. Can you think of any risks when it comes to this type of strategy? What should investors think about when it comes to risk?
Well, yeah, I mean, obviously the risk is that you own 85% of your money in the NASDAQ. So your principal value, if you will, is going to be really controlled mostly by that. There is some risk in the dividend futures market, but the way that futures market is priced right now is historically the NASDAQ has been growing its dividends by 13% per year annualized. Last year, they grew by 30%. Right now in the dividend futures market, we're paying 5%. So the difference between, let's say, that historical dividend growth and the current price in those futures contracts is about an 8% spread. If they come in at average, we're going to get that 8%. If they come in at 30, we're going to get 25%. But there's always a risk that in any broad-based index that has a number of stocks that the dividends could get cut. I think that risk is somewhat muted with the NASDAQ 100. One of the things I think is most interesting about this strategy is if you think about the big 7 names that are most of the weight of the NASDAQ 100, 5 of them don't pay dividends right now. 2 do, Meta and Apple. And I suspect that over time, because those other 5 companies are so flush with cash, that perhaps they'll start to add a dividend component to their stock price. And if that happens, then those dividends aren't currently priced into the dividend futures market. And so that will actually increase the value of those futures contracts that we own.
Sean, obviously, like you mentioned, the NASDAQ is made up of a lot of big tech companies. A lot of the investors that buy the NASDAQ, the triple Qs and things like that, they're interested in growth. But this is obviously a combination of growth and dividends. What type of investor do you think would appreciate this ETF, and how do you see it fitting into portfolios?
Yeah, it's a great question. So, we think it's not necessarily meant to be a competitor for the Qs, right? People who own the Qs want just straight up capital appreciation. But there's a group of investors in their equity portfolio that like to get an income from those equities. And as I said, there's only a couple of ways to do that. Covered calls have been fairly popular. We've talked about the pluses and the minus. Dividend-based strategies also is another way, but it has some constraints as well. If you seek out stocks that pay dividends, you typically wind up in sectors that don't have great earnings growth. And so what this does is it gives investors who are looking for income from their equity portfolio the appreciation that they want over time with the yield that they're looking to get. And so we think if you look at this 5 or 10 years down the road, the power of the equities in the NASDAQ 100 will grow that client's principal. And as we're targeting 6 times the dividend yield, their income will grow as well. So you have a little bit of a best of both worlds here.
Fantastic. Well, we're going to have to leave it there. Sean, it's been a pleasure. Thanks so much for your time.
Thank you so much. Always good to be with you.